Welcome back to The Explainer. So today, we're stepping into the shoes of macro detectives to investigate a pretty massive real-time financial mystery. We're talking about Bitcoin's dramatic plunge from that monumental $126,000 all-time high straight down to where it's hovering right now, which is around $80,000. Now, for a lot of market watchers, a drop that steep absolutely sounds the alarm. But, in the world of macro assets, the surface level rarely tells the whole story. So we're going to dig into the data, piece together the evidence, and figure out exactly what is going on behind the scenes. Which brings us right to the ultimate question we are solving today. Are we looking at a panic situation or a launchpad? Is this extended consolidation phase a trapdoor leading us straight down into some grueling bear market, or is actually a springboard being coiled super tightly for the next major leg up? If you just scroll through social media headlines, you might think the sky is literally falling. But as data-driven observers, we need to look at the structural mechanics. We want to know for sure if the smart money is running for the exits or if they're just quietly buying the dip. To solve this, our explainer is going to follow a really clear investigative path. First up, the 80K question. Second, reading the chart structure. Third, the wall of worry. Fourth, the digital gold narrative. And finally, 3 market scenarios. Let's dive in. All right, part 1, the 80K question. Let's investigate this consolidation zone. Moving to part 2, reading the chart structure. Think of this as clue number 1, the scene of the crime. Let's set the scene here. As of May 12th, 2026, Bitcoin is hanging out right around the $80,000 mark. And this is honestly one of the most critical consolidation phases of the entire market cycle. The question isn't really whether Bitcoin will survive the volatility, it's whether we're in a free fall or looking at a heavily defended fortress. If we look at the weekly time frame, specifically that 74,000 to 80,000 zone, throughout 2024 and into 2025, that exact region was a massive wall of resistance. It was the absolute ceiling. But notice how it has successfully flipped to become structural support. We can clearly see repeated retests of this area. What this tells us, as macro detectives, is that this isn't an accident. Institutional buyers are stepping in and actively defending this territory. And this structural foundation perfectly aligns with our key Fibonacci retracement levels. The 23.6% levels sits right around $75,449, which perfectly matches that defended support zone we just talked about. Looking above us, the 38.2% level is at roughly $85,144, and the 50% retracement sits near $93,000. Now, for the market to really regain its undisputed bullish momentum, the gatekeeper is that 38.2% level. Reclaiming the $82,000 to $85,000 resistance barrier is the immediate, absolutely crucial goal for the next leg up. Okay, part 3, the wall of worry. Clue number 2, the suspects. To truly grasp what's happening at these technical levels, we kind of have to shift our focus to market psychology. We need to look at the stark contrast in behavior between different market participants right now. On one side, you have everyday retail sentiment, which is traumatized, cautious, and basically anticipating the worst. But on the other side, institutional action is defined by quiet, strategic accumulation. This dynamic creates what traders call a wall of worry. Everyday traders are fearful, while the smart money is just steadily building their positions at a discount. And historically, this specific psychological environment appears during mid-cycle consolidations, not at final cycle tops. And the smoking gun of our investigation is this massive figure, $1.97 to $2.44 billion. In April 2026 alone, spot Bitcoin ETFs attracted this staggering amount of capital inflows. It was literally one of the strongest accumulation months of the entire year. Funds like BlackRock's ATH are just absorbing a massive share of the circulating supply. Long-term capital clearly views Bitcoin as a strategic macro asset right now, rather than just some speculative trade to dump when the waters get choppy. So why does this matter to us? Well, because ETF demand actively removes liquid supply from the ecosystem, building structural support right underneath the price. When institutions buy through these ETFs, they aren't day trading, right? They are locking up supply for the long haul. This means the market actually isn't nearly as weak as all that emotional retail sentiment might suggest. Long-term holders simply aren't aggressively selling, and that builds a rock-solid foundation under current levels. Moving on to part 4, the digital gold narrative. Clue number 3, the global backdrop. We obviously can't analyze Bitcoin in a vacuum. We have to look at how global macroeconomic events and geopolitical shocks drive the price action. And the recent timeline lays out this cause and effect perfectly. Step 1. In February and March of 2026, we saw severe geopolitical escalation involving the US, Israel, and Iran. That triggered a broad risk-off panic across all global markets. Step 2. Bitcoin initially reacted just like any high beta risk asset. It sold off sharply, the US dollar strengthened, and inflation fears roared back. But step 3 is where things get really interesting. The recovery phase revealed that Bitcoin is increasingly behaving as a hybrid macro asset. Once the initial volatility stabilized, institutional capital purposefully rotated right back into Bitcoin, treating it as digital gold. It fell with the risky assets, but recovered as a safe haven. That is a massive paradigm shift. All right, part 5, 3 market scenarios. Time for the verdict.
So, we've gathered the technical clues, the psychological evidence, and the macroeconomic context. When we bring all this data together, a pretty clear picture emerges. A bullish continuation is actually the most likely structural outcome, sitting at a solid 55 to 60% probability. A sideways or deeper correction is the next most likely at 30% to 35%, and that catastrophic bearish macro shock scenario, it's surprisingly low at less than 15%. Emotional sentiment might make you feel like the bear scenario is just around the corner, but the data firmly points toward bullish continuation as our primary expectation.
Let's just quickly break down the specific catalysts for each of these scenarios. In the bullish case, if Bitcoin holds that $78,000 to $80,000 region and punches through $85,000 with real volume, our targets rapidly shift to the $93,000 range. After that, we're talking about reclaiming that psychological $100,000 mark and pushing even higher later in 2026. And this case only gets stronger if those ETF inflows continue. Now, in the sideways scenario, failing to break $85,000 means we might sweep down into the $65,000 to $75,000 range, which fundamentally is still a very healthy cyclical correction. Finally, the bearish scenario. That would require severe geopolitical escalation, actual massive ETF outflows, and aggressive Fed tightening to drag us down to the $55,000 to $60,000 zone. But again, persistent institutional demand keeps that probability very, very low right now. So, what is the core finding of our whole investigation? It really comes down to this. Bitcoin appears to be transitioning from a panic-driven correction toward a much more stable accumulation phase. The bigger picture is clear. Yes, Bitcoin is correcting after a parabolic expansion, but the capital is not leaving the ecosystem. ETF inflows are strong, long-term holders are holding the line, and the market structure looks exactly like a consolidation under macro uncertainty, not a cycle top. I want to leave you with one final provocative thought today. As we've uncovered, the data tells a vastly different story than all those fearful headlines. The institutional foundation is literally being poured right before our eyes. So armed with all this structural evidence, you got to ask yourself, what will you do when Bitcoin tests that critical $82,000 to $85,000 barrier? Are you going to rely on emotional panic, or are you going to trust the data-driven perspective of a macro detective? Keep your eyes on those charts, keep learning, and I'll see you in the next explainer.